when the price climbs, but the shops are flooded with sellers. Something fundamentally broken is happening beneath the surface. Across multiple jurisdictions, coin dealers are reporting an unprecedented pattern. Retail holders liquidating aggressively, while institutional entities quietly accumulate at wholesale levels. But here's what nobody is discussing on camera. The authentication crisis spreading through physical markets, the liquidity fracture widening between paper prices and actual metal availability, and the counterfeit infiltration that's making even experienced dealers hesitant. 3 warning signals are converging simultaneously. And if you're holding physical assets or considering entering this market, what happens in the next 60 days will determine whether you're positioned strategically or caught on the wrong side of a structural shift that's already in motion. Welcome to Silver Radar. This is where serious analysis meets real-world market intelligence. Now, if you've been watching financial markets long enough to remember when monetary policy actually made sense, when a handshake meant something, and when market signals weren't drowned out by algorithmic noise, then you understand the value of clarity in chaos. We don't do hype here, we do homework. So if you appreciate research that respects your time and your intelligence, go ahead and subscribe to this channel. Hit that button like you're signing a document that matters. And while you're at it, tell us in the comments below. Where are you watching this from? What region? What market? Because these patterns we're tracking, they're not uniform. Geography matters, jurisdiction matters, and understanding who's watching from where helps us understand who's feeling the pressure first. Now, let's get into what's actually happening. The fluorescent lights flicker inside a family-owned coin shop in Phoenix, Arizona. A business that has survived recessions, market crashes, and every financial crisis since 1987. Today, however, the owner's face tells a story that technical charts cannot capture. His hands rest on a glass counter filled with freshly surrendered silver coins. "They're coming in waves," he says quietly. People who purchased at $24 per ounce are now selling at $32. Logic would suggest this represents profit-taking, a rational exit after capturing substantial gains. But the look in these sellers' eyes reveals something fundamentally different. This is not celebration. This is desperation. 3 time zones away, a dealer in Toronto reports an identical pattern. "We had 11 sellers yesterday and only 2 buyers. In Manchester, England, the story repeats. Physical silver flowing into shops faster than it flows out. Yet the spot price continues climbing, breaking through resistance levels that analysts predicted would hold for months. This creates a paradox that demands serious examination. Why are everyday holders liquidating during what appears to be a bull market? The answer lies in a concept most investors fundamentally misunderstand: the critical difference between price and liquidity. Price tells you what the last transaction achieved. Liquidity tells you whether you can actually execute that transaction when you need it most. These are not the same thing, and in stress conditions, that difference becomes devastatingly clear. Walk into any major coin shop today and observe the bid-ask spread. The gap between what dealers pay and what they charge has expanded dramatically. Historically, this spread hovered between 2 and 4% for common bullion. Today, it has widened to 7%, 9%, in some locations, 12%. A 1-ounce American Silver Eagle might sell retail for $44, but the dealer will only pay $38 to purchase it from you. That $6 gap represents something critical. Risk premiums that dealers are building into every transaction. "I don't know how long I'll hold this piece," explains a dealer in Denver. "Authentication concerns have made inventory management unpredictable." Translation: uncertainty has a price, and retail sellers are paying it with every transaction. Meanwhile, premium products command extraordinary markups. Government-minted coins carry $8 to $14 over spot price, but sellers never capture that premium when liquidating. The dealer retains it as buffer against authentication risk and market volatility. This creates an economic mechanism that few retail participants understand until too late. Buy at high premiums, sell at steep discounts, watch your capital erode in both directions. Now introduce the human element driving this wave of selling. Personal financial stress accelerating across middle-income demographics at alarming velocity. Credit card delinquency rates have climbed for 11 consecutive months. Personal savings rates have compressed to levels not observed since the 2008 crisis. Auto loan defaults are spiking. Mortgage payment stress is building quietly in suburban communities that appeared financially stable just 18 months ago. Against this backdrop, silver becomes a release valve, a tangible asset that can be converted to cash within hours. These holders are not selling because they've lost faith in silver. They're selling because the rent is due, the car payment is overdue, the credit card minimum is climbing. This is forced liquidation, not strategic exit timing based on technical analysis or market outlook. And forced selling occurs regardless of price, creating the seemingly impossible scenario of rising prices amid rising supply at retail channels. But here's where the analysis becomes critically important. While retail participants liquidate under financial pressure, Physical delivery requests at wholesale institutional levels have surged dramatically. Industrial manufacturers, sovereign wealth entities, and large-scale institutional buyers are absorbing metal at unprecedented rates. These two groups never interact directly. The retail seller in Phoenix never meets the institutional buyer in Singapore. Yet their opposing actions are creating a market structure, one that historical analysis suggests precedes significant dislocations. The retail seller receives $38. The institutional buyer pays $34 at wholesale volume. The dealer captures the spread, but also absorbs the authentication risk, storage costs, and market timing uncertainty. What emerges is a multi-tiered market structure, where information asymmetry and capital access determine outcomes more than timing or analysis. The Phoenix dealer glances at his inventory, rows of freshly acquired Eagles, Maples, and generic rounds. This feels like 2008, he says without emotion. People selling assets they wanted to keep because they have no other choice. The liquidity fracture is not theoretical. It's visible in transaction logs, spread analysis, and dealer inventory velocity. It's measurable in the gap between paper price discovery and physical settlement reality, and it's accelerating with each passing week. The question is no longer whether stress exists in physical silver markets. The question is, what happens when this stress reaches its breaking point, and whether retail participants will recognize the warning signals before liquidity disappears entirely. A seemingly perfect American silver eagle sits under magnification in a Las Vegas verification lab. The weight registers correctly at 31.1 grams. The dimensions match U.S. Mint specifications precisely. The ring test produces the expected tone. Yet the technician's expression darkens as the ultrasonic scanner reveals what the human eye cannot detect. Austin, tungsten core, he announces quietly, wrapped in genuine silver plating, approximately 0.5 millimeters thick. This single coin represents a sophistication level that would have been impossible to achieve economically just 5 years ago. Today, it's becoming routine. The counterfeit problem in physical silver markets has evolved beyond crude forgeries that any experienced dealer could identify immediately. What's emerging now is industrial-grade replication, manufactured with precision that challenges even professional authentication equipment. And it's not isolated to obscure secondary markets or questionable online sellers. Verified cases have surfaced in estate sales, reputable auction houses, and even inventory received from seemingly legitimate wholesale sources. The infiltration is systemic, not episodic, and every confirmed case amplifies dealer anxiety across the entire distribution chain. Consider the economics driving this infiltration. When silver traded at $18 per ounce, the profit margin on a sophisticated counterfeit barely justified the manufacturing complexity. At $32 per ounce, those economics shift dramatically. A tungsten core counterfeit cost approximately $4 to produce at scale. Sold into the market as genuine, it generates $28 in profit per unit. Multiply that across thousands of units, and the incentive structure becomes clear. Criminal enterprises are not opportunistic amateurs operating from basements. These are organized manufacturing operations, often located in jurisdictions with limited enforcement cooperation, producing counterfeits with industrial efficiency. The technical sophistication continues advancing. Early counterfeits failed basic tests: incorrect weight, poor strike quality, obvious color differences. Modern counterfeits defeat casual inspection entirely. They match weight specifications through tungsten cores that have nearly identical density to silver. They replicate edge reading, surface texture, and even the subtle frosting on proof finishes. Some counterfeits now include correct magnetic properties, defeating one of the simpler at-home authentication methods. Others have mastered the acoustic signature, producing the distinctive ring that silver enthusiasts rely upon for quick verification. What remains detectable requires equipment that costs between $1,200 and $8,000. Ultrasonic thickness gauges, X-ray fluorescence analyzers, and precision electronic calipers capable of measuring to thousandths of a millimeter. Equipment that most individual buyers do not possess. This creates an authentication asymmetry. Dealers with proper equipment can verify. Individual buyers operating in secondary markets cannot. The result is a two-tier market structure where certified, verified metal commands increasing premiums, while uncertified metal faces growing skepticism and pricing discounts. A dealer in Seattle describes the operational impact. Every piece that comes through our door now gets tested, regardless of source. That's 15 minutes per transaction minimum, sometimes longer. It's slowing everything down and increasing our labor costs substantially. Those costs don't disappear. They transfer to customers through wider spreads and lower buy prices. But the deeper damage extends beyond transaction costs. Trust erosion is undermining the fundamental value proposition of physical silver ownership. Investors choose physical metal specifically because it represents tangible, verifiable wealth outside the financial system. When verification itself becomes uncertain, that value proposition deteriorates. The psychological impact manifests in dealer behavior patterns. Shops that previously accepted walk-in sellers without hesitation now require appointments, allowing time for thorough testing. Some dealers have stopped purchasing certain products entirely, particularly generic rounds and bars from unfamiliar mints. Others have implemented strict provenance requirements, accepting only pieces with documented chain of custody. This verification hesitancy compresses liquidity further. The retail seller facing financial pressure discovers that converting silver to cash now involves waiting periods, additional scrutiny, and often outright rejection. The asset they purchased for its liquidity characteristics has become substantially less liquid. Meanwhile, counterfeit infiltration creates inventory risk that dealers manage through pricing adjustments. When a dealer cannot be completely certain of authenticity despite testing, that uncertainty becomes a cost. The cost appears as a larger spread between buy and sell prices, or as categorical refusal to purchase certain products. Stories circulate through dealer networks about near misses and actual losses. A Minneapolis dealer who unknowingly purchased 37 counterfeit Sunshine Mint rounds, discovering the issue only after reselling 12 of them. A Florida shop that accepted a complete monster box of Silver Eagles, later discovering that 43 of the 500 coins were sophisticated counterfeits. Each incident reinforces caution and defensive purchasing strategies. The authentication crisis also enables a predatory secondary effect. Legitimate sellers with genuine metal now face suspicion and reduced offers simply because counterfeits exist in the market. Their genuine pieces are discounted not due to any flaw, but due to systemic trust erosion. They bear the cost of someone else's criminal activity. And here's the strategic element that sophisticated observers recognize. As authentication becomes more expensive and time-consuming, as trust erodes and liquidity compresses, the market naturally consolidates toward larger participants with verification infrastructure. Small individual holders become increasingly disadvantaged. Institutional buyers with testing capacity and volume access gain structural advantages that widen over time. The counterfeit crisis is not merely a quality control problem. It's a market restructuring mechanism that's redistributing power, access, and profitability away from retail participants toward institutional players who can afford the authentication infrastructure that physical markets now demand. A shipping manifest dated 3 weeks ago tells a story that retail coin shops will never witness firsthand. Destination: Singapore. Contents: 47,000 ounces of investment-grade silver bars. Origin: a Swiss refinery that deals exclusively in wholesale quantities. The transaction occurred at spot price plus 63 cents per ounce. No retail premiums, no authentication delays, no bid-ask spreads that devour 8% of transaction value. This is the market that exists parallel to the coin shop liquidations happening in Phoenix, Toronto, and Manchester. Two markets, same metal, completely different economics. And the gap between them is widening. While retail holders stand in coin shops accepting $38 for eagles that trade at $44 retail, institutional entities are securing metal through channels that operate by entirely different rules. These transactions don't appear in dealer case displays. They don't generate social media posts or YouTube testimonials. They happen quietly, methodically, in quantities that would overwhelm any local coin shop's annual volume. The institutional buyers accumulating physical silver right now fall into 3 distinct categories, each with strategic motivations that have nothing to do with technical chart patterns or retail investor sentiment. First category: sovereign wealth entities and central banks in jurisdictions actively reducing dollar exposure. These institutions aren't speculating on silver's price trajectory. They're repositioning reserves away from currency risk and toward tangible assets with industrial utility. Their time horizon is measured in decades, not quarters. Their accumulation occurs regardless of short-term price movements. Public data from customs records and refinery shipments reveals consistent patterns. Monthly deliveries to Middle Eastern sovereign funds have increased 41% year over year. Asian central bank acquisitions, though not officially reported as silver holdings, appear in trade flow data as monetary metals shipments that suspiciously correlate with silver pricing periods. These entities operate with information advantages that retail participants cannot access. They maintain relationships with primary refineries. They receive production directly from mining operations. They bypass every intermediary that adds cost and friction to retail transactions. Second category: industrial manufacturers, facing supply chain vulnerabilities in critical production inputs. Silver is not optional in solar panel manufacturing, electronic components, or advanced medical equipment. It's functionally irreplaceable in many applications due to its unique conductive and antibacterial properties. Manufacturing executives who lived through the semiconductor shortage and the lithium supply crisis are now applying those lessons to silver procurement. The strategy is straightforward: secure physical inventory before supply tightens, even if current production doesn't require immediate delivery. Lock in pricing, eliminate exposure to spot market volatility, Corporate filings from major solar manufacturers reveal inventory buildups that exceed normal operational requirements by substantial margins. One Chinese solar producer increased silver inventory by 312% in the past 18 months, despite production growth of only 47%. This is strategic stockpiling disguised as operational inventory management. Third category, institutional investment funds operating in the physical commodity space with capital access that dwarfs retail participation. These entities purchase in 1,000-ounce bar formats, store in allocated professional vaults, and maintain positions through market cycles that would psychologically destroy typical retail investors. The critical distinction is capitalization and staying power. When retail holders face rent payments and credit card bills, institutions face no such pressure. They can hold through volatility. They can accumulate during retail liquidation events. They can wait years for strategic exits. The pricing mechanism itself reveals this institutional dominance. Retail buyers pay spot plus $8 to $14 premiums for government coins. Retail sellers receive spot minus $3 to $5 discounts. The round-trip cost of a retail silver transaction can easily consume 15 to 20% of the position value. Institutional buyers pay spot plus 50 to 90 cents for 1,000-ounce bars. No premiums for fancy mint marks or government guarantees. Just refined silver meeting London good delivery standards. Their transaction costs measure in fractions of 1%, not double digits. This cost structure creates an insurmountable advantage over time. The retail participant who buys a silver eagle at $44 needs the spot price to reach approximately $39 just to break even after selling back to a dealer. The institutional buyer, who secures bars at spot plus 60 cents, breaks even if silver moves just 60 cents. Geographic patterns in institutional accumulation reveal strategic positioning that suggests preparation for specific scenarios. Singapore vault holdings have expanded dramatically, coinciding with that nation's emergence as a precious metals trading hub with favorable regulatory treatment. Dubai has established itself as a physical delivery point with infrastructure supporting large-scale transactions outside Western financial surveillance. Switzerland continues its historical role as a refining and storage center, but flow patterns show metal moving through Swiss facilities toward Asian destinations at rates that significantly exceed historical norms. The metal is being repositioned geographically, away from traditional Western custody toward jurisdictions with different monetary relationships and strategic priorities. Contract structures in the wholesale market also differ fundamentally from retail transactions. Institutions negotiate multi-year supply agreements with refineries, locking in production at fixed premiums regardless of spot price movements. They establish credit lines secured by physical metal holdings, creating leverage opportunities unavailable to retail participants. Some institutional buyers are even purchasing mining operations directly, securing silver at production cost rather than market prices, a strategy that completely removes them from market pricing mechanisms that retail investors must accept as given. The information asymmetry extends beyond pricing to market intelligence. Institutional buyers maintain relationships with mining executives, refinery operators, and industrial consumers. They understand supply constraints, production forecasts, and demand trends months or quarters before this information reaches public awareness. When retail investors rely on publicly available data, market commentary, and price charts, they're operating with information that institutional players digested and acted upon weeks or months earlier. The current market structure creates a wealth transfer mechanism that operates continuously. Retail holders, pressured by personal financial stress and lack of staying power, liquidate to dealers at discounts. Dealers aggregate that metal and sell into wholesale channels. Wholesale distributors deliver to institutional buyers at minimal premiums. The metal flows systematically from weak hands to strong hands, from forced sellers to strategic accumulators. And the retail seller standing in the Phoenix coin shop accepting $38 for his eagle has no visibility into where that coin ultimately ends up, or who benefits from the $14 spread between his selling price and its eventual destination. The institutional divergence is not a conspiracy. It's simply structural advantage, deployed systematically, creating outcomes that favor capital, information, and patience over urgency, ignorance, and need. The question facing any serious market participant at this juncture is not whether the patterns documented in parts 1 through 3 exist. The evidence is conclusive. The question is what strategic response these patterns demand from individuals operating without institutional advantages, capital depth, or information access. The framework for navigation begins with brutal honesty about structural disadvantages. Retail participants cannot eliminate the spread between buying and selling prices. They cannot access wholesale pricing. They cannot negotiate multi-year supply contracts with refineries. They cannot store metal in Singapore allocated vaults with institutional insurance coverage. Pretending these disadvantages don't exist leads to costly strategic errors. What remains accessible, however, is mitigation through informed decision-making, careful counterparty selection, and disciplined authentication protocols that reduce exposure to the most severe risks. Authentication represents the first line of defense in an environment where counterfeit infiltration has reached industrial scale. The tools required for basic verification are accessible to individual buyers, though they require upfront investment and learning commitment that many participants avoid until after experiencing losses. A precision digital scale capable of measuring to hundredths of a gram costs between $40 and $120. This single tool eliminates the crudest counterfeits immediately. Genuine silver coins have weight specifications that counterfeits struggle to match exactly, particularly when tungsten cores are involved. A supposedly 1-ounce coin that registers 30.8 grams or 31.4 grams fails the first authentication test. Specific gravity testing, which measures density by comparing weight in air versus weight in water, provides deeper verification. Silver has a specific gravity of 10.49. Tungsten measures 19.25. A composite counterfeit with a tungsten core wrapped in silver plating will produce a specific gravity reading somewhere between these values, revealing its fraudulent nature. The equipment required costs approximately $60 to $150 and can be assembled from readily available components. Magnet testing offers another accessible verification method, though its limitations must be understood. Pure silver is diamagnetic, meaning it exhibits slight repulsion to magnetic fields. A strong neodymium magnet sliding slowly down a silver bar or coin will move noticeably slower than it would on non-magnetic metals. This test costs $20 and provides quick screening, though sophisticated counterfeits have learned to mimic this property. For serious participants managing positions above $10,000, investment in an ultrasonic thickness gauge becomes economically justifiable. These devices, costing between $1,200 and $3,000, measure material thickness with precision that reveals plating on counterfeit cores. The technology cannot be easily defeated without manufacturing costs that eliminate counterfeiting profitability. But authentication equipment alone provides incomplete protection without disciplined counterparty selection. The source of metal matters as much as verification of the metal itself. Government mint products purchased directly from authorized dealers carry authentication advantages that generic rounds from unknown mints cannot match. The premium paid, typically $8 to $12 over spot for American Eagles or Canadian Maples, functions partially as authentication insurance. Counterfeiters target these products specifically because of their liquidity and recognition, but authorized dealer networks maintain quality control that substantially reduces counterfeit infiltration risk. Dealer reputation verification requires research beyond Google reviews and social media presence. Membership in professional organizations like the Professional Numismatists Guild or Industry Council for Tangible Assets indicates dealers who submit to ethical standards and dispute resolution processes. Years in operation under consistent ownership suggests stability and reputation investment that fly-by-night operations lack. Transaction documentation becomes critical for establishing provenance and protecting resale value. Receipts should specify product details, weight, fineness, and dealer information. Photographs of purchases, particularly of unique identifiers like serial numbers on bars, create evidentiary records that support authentication if questions arise later. Storage decisions carry security and liquidity implications that deserve careful analysis rather than default assumptions. Home storage provides immediate access and eliminates custodial risk, but introduces theft vulnerability and insurance complications. Professional vault storage offers security and insurance, but adds costs and reduces immediate liquidity. The hybrid approach employed by sophisticated individual holders involves tiered storage. Immediate liquidity needs, perhaps representing 3 to 6 months of potential expenses, remain in secure home storage with quick access. Larger strategic holdings reside in professional allocated storage where insurance, security, and verification infrastructure justify the ongoing costs. Premium analysis represents another critical skill that separates strategic participants from reactive buyers. Premiums fluctuate based on supply, demand, and market psychology. Buying government mint products at $15 premiums during panic buying episodes locks in costs that can take years to recover. Patience to accumulate during premium compression periods dramatically improves long-term position economics. Historical premium data reveals patterns worth studying. Premiums expand during retail buying surges and compress during liquidation waves. The current environment, characterized by retail selling and premium maintenance, suggests dealer inventory concerns and institutional demand keeping premiums elevated despite retail supply. This is not the environment for aggressive accumulation unless specific authentication and sourcing advantages exist. Liquidity planning demands honest assessment of personal financial resilience. The retail sellers liquidating in coin shops today likely believed they could hold indefinitely. Personal circumstances proved otherwise. Forced selling during disadvantageous market conditions destroys the strategic value of physical asset positions. The institutional approach to position management involves never allocating capital to physical metals that might be needed for operating expenses within a 3 to 5 year horizon. This time, buffer allows positions to survive volatility, liquidity compression, and temporary price dislocations without forcing disadvantageous exits. Position sizing connects directly to liquidity planning. A $50,000 silver position represents strategic positioning for someone with $2 million in liquid assets. For someone with $80,000 in total net worth, it represents dangerous concentration that increases forced liquidation probability. Diversification within physical holdings also merits consideration. Government mint products offer maximum liquidity but command highest premiums. Generic rounds and bars reduce premium costs, but face greater authentication scrutiny and liquidity challenges. Larger bars, such as 100-ounce or 1,000-ounce formats, offer lowest premiums but severely limited retail buyer pools. The strategic position balances these factors: sufficient government mint product for liquidity needs, larger formats for cost efficiency on longer-term holdings, and documentation plus authentication capability for the entire position. Market timing, despite consuming enormous attention in retail investment communities, matters less than structural positioning. The retail participant who purchases at optimal prices but must liquidate during crisis conditions underperforms the institutional buyer who accumulates at higher prices but holds through volatility with zero liquidation pressure. The warning signals visible in current market behavior suggest preparation rather than panic. Liquidity stress at retail levels, authentication crisis expansion, and institutional accumulation during retail liquidation have historically preceded either major price dislocations or structural market changes. For positioned participants, this environment demands verification of holdings, confirmation of storage security, review of liquidity buffers, and emotional preparation for volatility. For prospective participants, this environment suggests caution about entry timing and careful attention to authentication, sourcing, and premium analysis before committing capital. The institutional advantage cannot be eliminated, but its impact can be reduced through discipline, education, and strategic patience. Those who understand the structural dynamics, who verify rather than trust, who plan for stress rather than hope for stability, who accept temporary illiquidity in exchange for long-term positioning, these participants survive market dislocations that destroy reactive capital. The metal shops are witnessing something significant. Whether it represents opportunity or warning depends entirely on preparation, positioning, and strategic clarity about objectives that extend beyond short-term price movements into fundamental questions about monetary system stability and asset preservation across uncertain decades.